Marty Fraser again from Stone Success Realty. Today, I want to talk to you a little bit about 8 common reasons why somebody is turned down for a mortgage. So when you're going out there to buy a house, you always need to go and speak to your financial institution or your mortgage broker well in advance to get the process rolling. But sometimes there will be instances where one is turned down for the loan and it can be a major disappointment. And right now, about 25% of all mortgage applications are denied. So if you want to reduce the chances of being turned down, let's follow these 8 guidelines. So the first one is, some people are going to have bad or bruised credit. It does happen, and they will look at your credit history when they're applying for your loan. But the best way to keep track of this is make all minimum payments on your cell phone bill, your credit card, and avoid any bankruptcies if possible, because that will impact your ability to purchase a home with financing. Second item here is poor income documentation. So right from the start, go get your most recent pay stubs and a letter of employment from your employer outlining what it is you make. Keep in mind, you will not be able to count any overtime money that you make throughout the course of the year. The financial institutions just qualify you on your base pay. And also get those notice of assessments at least the last 2 years to your mortgage broker. Another item is just having a small down payment, and a small down payment will impact how much you're able to spend, and that may impact the reason that you are turned down. Right now in Canada, the minimum for a mortgage is having 5% down. So sometimes the issue has to do with the house. Every time a mortgage application is put in, the lender will examine the appraisal for that particular home. And if the home does not appraise for the amount you're looking to have borrowed, that may be a reason why the application gets turned down. Another item is the unstable employment history of an applicant. So if you've changed jobs a few times, they will look at that, and you may be deemed a bit more higher risk than somebody's been with the same employer over the last few years. The other item that the financial institutions are going to look at are the debt to income ratios. So those 2 ratios are gross debt service ratio and total debt service ratio. And your mortgage broker will explain to you what those are. But if you do not meet those thresholds or limits, one will get denied. Another item is new debts incurred or any employment changes. So I always say to people when they're looking to buy a house, do not go out and buy a new car or take on a car loan. Do not go out and get another credit card. Do not change jobs, or do not deposit or withdraw any large sums of money that are not necessarily easily explained, as these items will also play a part in the examination of the application. And the last item is, from time to time, lending guidelines will change in Canada. So to ensure a solid real estate industry and mortgage market, from time to time, the federal government will change the rules to ensure credit-worthy people are buying the houses. So I often say booms are driven by strong demand and constrained supply, whereas bubbles are driven by greed and extreme leverage. And right now, Canada has the former and not the latter for these lending guidelines, which is good and ensures a stable market. So bottom line here, if you want to increase your chances on the application, follow these 8 tips, and you can also save as much money as you can prior to closing so that you can cover all those closing costs and more, and get all your documents to your lender as soon as they're asked for, or even better, in advance. So these are my thoughts. Please feel free to comment on this or any other real estate topic. I'd love to hear from you, and please subscribe to my YouTube channel.